This is Matthew Cratter from Trader University, and today I want to talk about why inflation is worse than you think. I think this meme sums it up pretty well. First, there's no inflation. Then inflation is low. That's okay. Inflation is transitory is a lot of what we were hearing for the past 12 months. We haven't quite gotten to the point where people are saying inflation is good. Those central bankers certainly like inflation. Just as recently as June of this year of 2021, Jerome Powell, who's the head of the Federal Reserve, which is a central bank in the U.S., was saying that inflation is transitory, meaning that it was going to go away soon. And then a couple months later, at the end of September, he said it's frustrating that it hasn't gone away. Now he's blaming it on China supply chain bottlenecks. The one thing he never seems to notice or blame it on is his own money printer, which increases the money supply and causes inflation in the most simple terms. So we got an inflation reading yesterday. The Consumer Price Inflation Index, the CPI, came in at 6.2%. This was the highest reading since 1990. And it's actually higher than that when you consider that the CPI is a fake, manipulated government index. Like most things the government does, it does it quite badly. And in this case, what has happened over the past few decades is the economists at the U.S. government have changed the inputs, they've changed the basket, and they've changed the methodology that is used to calculate CPI inflation. And so the actual rate of inflation, if you use the old calculation parameters, is much, much higher. This is what Jack Dorsey's talking about in this tweet from yesterday. Try measuring inflation using the pre-1980 methodology. Fortunately, there's a group who does this. They're called shadow stats. And we can see in this chart here that the regular inflation, the inflation, sort of headline inflation that we're hearing about, the 6.2% inflation, which is this new way of calculating inflation that's at 6.2%. But if you go back and you use the original calculation for CPI, current inflation is coming in very close to 15%, and it's as high as it's been since 1981. So things are much more dire than you would otherwise believe if you didn't understand that they changed the index. This is one of the slimiest things that the U.S. government does, manipulating statistics in this way to understate the true rate of inflation. If you're finding this video helpful so far, be sure to hit that subscribe and like button. Maybe share this video with a few friends as well. But I want to talk about one way in which inflation is actually much worse than even these headline numbers would lead you to believe. We've talked about, over the past 12, 18 months, we've talked about Jeff Booth's book a few times. It's called The Price of Tomorrow. Definitely worth reading. It's not that long. And it contains some really profound things. What he does is he talks about the issues surrounding deflation and inflation with reference to technology, and really what makes the modern world so different from the world of our ancestors is the accelerating rate of technology. We've always had technology ever since chimpanzees started using sticks to get ants out of anthills. But the kind of technology we're using now and the way it compounds means that there are actually deflationary pressures in the economy, which is what I'm going to talk about now. If we define technology, if we can loosely define it as doing more with less, getting more done with fewer inputs. Obviously, harvesting wheat by hand with scythes is very inefficient. It's good exercise, but it's less efficient than using camels, for example. Here's something from 1910 from Russia where camels are being used to pull a plow or pull a harvester. The modern version of this, of course, looks more like something like this, and can do the work of what it used to take hundreds of men to do. Obviously, we all know about the iPhone and smartphones and the huge leaps that they have, forward that they have led to. You can do so much on your iPhone that you couldn't even do on a desktop computer, say 15 or 20 years ago. So this is what technology does. It allows you to do more with less. And as a result, it's deflationary. You used to have to own a GPS and own a calculator and own a camera, etc. Now you get everything packaged in an iPhone. So iPhone's a great example of doing more with less. Now, being able to do more with less is profoundly deflationary. What deflationary means is things just cost less. And as a result, because there's technology all around the economy, we have spreadsheets, we have software, we have automation, we have robots, etc. The price of almost everything should be falling. I think Jeff Booth just makes up this number, but the thing should be falling by anywhere between 3% and 20% a year. The prices of almost everything, simply because due to the deflationary trends caused by technology. And so what this means is that inflation is actually much worse than even the headline inflation, because if you have this tailwind of 5%, where prices should be falling 5% because technology allows you to do more with less, you can now do everything on a desktop that it used to take a full back office to help you with. If the prices of everything should be falling by 5%, and they're not. In fact, they're rising by 6.2%, as evidenced by the October CPI number. What this means is that the actual rate of inflation is 11.2%. We're just adding these two, and maybe adding them is not exactly the right way to do it. Maybe we should be multiplying by 1 plus one of them, but it's a good estimate. And what this means is that the real rate of inflation is closer to 11%. Prices are falling because of all the good that tech is doing, and so it only appears, in fact, that prices are rising by about 6%. If we use the shadow stat numbers, this gets even worse. Shadow stats say that we're close to 15% CPI inflation, as we pointed out, using that old 1980 methodology. If prices are actually rising 15% according to a true CPI, not a manipulated CPI reading, that means that the actual rate of inflation is 20%. Technology is just helping us by creating that 5% per year tailwind. And so I would say this 20% a year seems to be a little bit closer to where things are. Obviously, housing prices have been going up 15, 20% for the last year or so. And I would say that 20% really is closer to the true inflation rate. Another way of measuring or eyeballing the true inflation rate is just think of money supply growth. So this is the M2 money supply, and these are year-over-year changes. We can see that something very different happened beginning with the first quarter of 2020 when the pandemic hit and the central bank, the Fed, decided to rev up the money printers. We've had inflation as measured by M2 money supply year-over-year growth anywhere between 10 and call it 26% right now, hovering around 12, 13%. And so this would seem to confirm the shadow stats inflation rate as well. So what's happening? Why is the U.S. allowing this? The funny thing, or the strange thing, is that the U.S. the U.S. government and the Fed actually want this inflation, but they don't want to scare anyone because we have a very serious debt situation. Debt to GDP is at the highest levels we've seen since the end of World War II. It peaked out in the middle of last year at around 135%. This is total public debt divided by GDP, which is just a measurement of the size of the economy. So what the Fed needs to do is they need to print money, and they need to cause inflation to inflate our way out of this debt. And how exactly does this work? I'm going to give you a very simple example, just looking at taxes. Obviously, higher taxes help the government to pay off its debt. And as salaries rise, as the whole economy grows, salaries rise, and taxes rise as well, which means that government tax receipts go up. So here's a very simple example. I'm just taking the median U.S. Household income. I believe it's around $70,000. I'm not looking at state income taxes. We're just talking about federal taxes here. As of 2020 rates, if you earned $70,000 and filed jointly as married, you paid roughly $10,000 in taxes last year. Now, let's say due to inflation, we get a bunch of wage increases to help keep up with the cost of living. And let's say in a few years from now, the household median income goes from $70,000 to $140,000. In this case, the tax receipts would more than double, simply because if wages go up and you leave the tax brackets where they are, basically everyone ends up paying more in taxes. We can see here that it's much more than it goes from 10,000 to 27,000. So it almost triples. As we said, this is going to happen until debt to GDP levels get back down to more normal levels. So we can expect a highly inflationary decade ahead. If you want to do a calculation of how this will affect you in daily life, here we have a future value calculator. I'm just pretending the price of a Big Mac costs roughly $5 now. I'm saying let's let the price of a Big Mac go up 6.2% every year for 10 years. What will be the price of the Big Mac? If it's starting at $5, what will be the price of the Big Mac in 10 years? It'll be almost $9 if the CPI stays where it appears to be, at least according to fake government statistics. What if we use a more real compounding rate and say the actual inflation rate is more like 20%? This would be a quite high inflation rate, but we may actually already be there because of all the Fed money printing. If you start with a $5 Big Mac and it goes up 20% a year for 10 years, your Big Mac in 10 years from now will cost almost $31. This is how scary inflation is. And what it means, the sort of the inverse of inflation is loss of purchasing power. That means if you have $100,000 sitting in the bank, it's not earning any interest, and the inflation rate stays at 6.2%, the value, the purchasing power of that $100,000 in 10 years from now will be only $55,000. This is why it's very important to be invested in stocks, and I would say it's most important to be invested in Bitcoin. If you don't own any Bitcoin at this point, that's fine, but you should be doing your research. My channel contains hundreds of videos talking about Bitcoin, and if these inflation numbers don't wake you up and make you realize the importance of having an inflation hedge for the coming decade, I don't know what will. I expect inflation to not only not be transitory, but to accelerate in the coming months and coming years. So make sure you have some Bitcoin for you and your family. If you found this video helpful, be sure to hit the subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.